So I have a question for the group here, and I'm going to start with Big Mike. You know, the elephant in the room right now is valuations. We have no idea. So my question is, current and future valuations, as a real estate operator, where do you see the largest opportunities for lower values? And then, you know, and we're going to start with property type, not necessarily geography. So Mike, where do you see the opportunity for lower values going forward in your particular market?
So, a fund manager, we have a very diversified portfolio of assets. So, we do have a saving grace that we have nothing in hospitality. It's one sector we don't have anything in.
Right.
Everything I hear, hospitality is trading at a massive discounts. And so, the sellers who need to sell are giving away the farm today if they need. And by the way, a lot of transactions are happening today in the debt secured by these hotels and such. So you could buy a note now at a good discount to the unpaid principal balance already in that sector. So that sector is hit the hardest, and the biggest opportunity is beginning to happen. The market is very fluid, and it's really hard to say what's the fair price. Volatility is high, uncertainty is high. The next sort of a sector that's sort of beyond the hospitality is taken on the chin is the retail sector. So a lot of small shopping, well, the plazas are closed completely, obviously. The malls are closed. The shopping plazas, grocer anchored, pharmacy anchored, they're still doing okay. They're surviving, but all the gyms are closed, all the nail salons are closed, and so on. So the opportunities, again, they're coming up. The stuff is not yet trading because we're in a sort of this freeze mode. So everything I'm saying is, where I see the significant opportunities, there will be, again, hospitality, then sort of retail, and then you go into multifamily. In the multifamily, the discounts will be really a function of rent collections, depending on type of assets. So it's a C-minus assets will be having all kinds of rent collection problem, blue-collar folks who are unemployed. And if a property manager is not able to manage the tenants well, like Randy does a great job managing the tenants. If you have that relationship with tenants, when they get their checks from the government, unemployment checks, the $1,200 per adult, $500 per child, they'll make the payments, at least partial payments. That's a good situation. There's going to be rental complexes that you're going to have pretty bad collection problems because of the composition of the tenants. And if the tenants catch on some kind of concept like a rent strike in some of the socialist republics of Illinois or California or New York, you can't evict. They choose not to pay. These assets are going to get stressed, and there will be opportunities in them. Again, it's not happening today yet. There's not enough data. Only we're beginning to see data for April, and then May 1st there will be more data, probably worse data than the April data. Then you gravitate into other asset classes like self-storage. They seem to be doing fairly well. The demand has spiked for self-storage as the economy went into instant recession. So I think self-storage assets are probably going to be less affected, maybe even positively affected. Then residential assets. I mean, we are in CG. We've been on CG calls. We've got a number of other discussions, and the most affordable subsector of the market is doing very well. So affordable range, entry-level, turnkey range seems to be doing well. If people downsize, they'll downsize into more affordable range. The above average assets, the high-end stuff is softening everywhere. Every conversation I have, that stuff is softening, and discounts already necessary to move that type of a product. So the answer to the question is, if you're a buyer of these assets, you certainly want to participate today. What I like to do is to participate through debt. Somehow you can acquire senior debt on any of these assets at a steep discount in hospitality. And if it's not hospitality, it's just, anything. If you can acquire distressed debt and you feel safe about, some degree of valuation, you could discount at 20%, 30%. But if you're acquiring the debt at 40% investment to value, you feel pretty safe, even if the value drops by 20, 30%.
Right.
Nice. All right. Before I try Sean again and see if he's up and running, I want to make sure that listening audience understands that you can ask questions. Just go into the chat, try to answer them as long as we have time to do so. Don't forget to subscribe and share. Leave a question in the chat box, I'm sure. Sean, are you working?
Hey, man, I'm good. Yeah, I apologize for the technical. I need encouragement.
So All right. So before you get started with similar question that we just asked Mike, give me a little lowdown on your business and what you focus on.
Yeah, so Tuscan Gardens, we're developing senior living communities primarily around the state of Florida, and we're now branching up into the Southeast. So specifically, we're developing and acquiring independent living, assisted living, and memory care communities. Again, these are all high-end private pay communities. Again, primarily in the state of Florida, but we are starting to branch out in the Southeast. So quick overview.
Excellent. So that brings me to another question. It's mostly high-end stuff. Your current clients, if they've been invested in the stock market, they don't have nearly as much money as they started off with a few months ago.
Right.
And it's too soon to find out now. But if you're at that age, you shouldn't have been invested in equities anyway. You should have been invested more in guaranteed returns.
Having said that,
Right. So are you seeing anything so far that might be an issue to get? I mean, let's face it, you're not going to have a lack of customers. We're all getting older.
Right. Yeah, it's a good point. And we're actually at the community levels, we're doing fine. I mean, we've been on lockdown for about 6 weeks now. We were actually ahead of the curve on the federal side and on the state side. So we're, obviously in a demographic that, COVID-19 is, fatal to our residents. So we've taken every precaution, but we are, as you mentioned earlier, I mean, all joking aside, senior living is needs driven. And we had 6 folks move into our Venice community last month. So, again, when you need it, you need it. And that's one of the reasons, senior living does tend to be more defensive. It acts more defensively. At least it did in 2008. And we're seeing it now. But, again, we're still pushing forward.
So do you see any opportunities for buying existing notes, perhaps, like Mike was saying, at a discount in your senior living space?
It's funny. We have LOIs out on 2 communities in the state of Florida. And we've actually experienced the exact opposite because those PPP checks are saving these communities, unfortunately for us. These communities were built by multifamily developers who did not understand how to, operate a senior living community. They were basically running out of cash, and the debt holders were getting ready to take the communities, themselves. And now, again, they're starting to get these inflows of dollars. We think it's something that's going to, stall the acquisition opportunity. But
right.
In the real short term, it's actually hurt us.
For those who don't know what an LOI is, that's a letter of intent. So they were making offers to purchase properties, and now they're getting extra money. So they may not want to sell.
Yeah, not quite yet.
Fuquan,
it's probably inevitable.
Get to the valuation side. What are you seeing in your market?
Well, we're seeing a lot of mom and pop owners, as I stated on the last session that we had, seeing a lot of great opportunities in the C+ residential area. They're in dire need of liquidity, especially in the communities where I'm invested. They're really getting hit hard. A lot of them were taking it, I would say, as a joke in the beginning 8 stages of March. People were not, practicing the social distance over the last 2 weeks, and now you go through those areas, you see everyone with a mask. In fact, in New Jersey, we're second highest cases nationwide, in the state, in the country. So, it's getting real serious. The opportunities will be the mom and pops looking for liquidity in the C+ class areas, 1 through 4 families. We actually, as I was stating in the last session, put together a marketing campaign to kind of do subject twos and give them the needed liquidity so they can do what they need to do, and we can keep investing in those areas. On the note side also, we know that since unemployment rate, which is the number 1 indicator for us in the note space, is high, that's going to trigger a lot of people not paying the second mortgages, which is one of our specialties. So we anticipate, late 3rd quarter, 4th quarter, a spike in, assets to sell at lower prices, going to shift back to a buyer's market. I'm also now looking into some of the private lenders and hard money lenders. I think there would be a tremendous amount of opportunity there for contractors who are defaulting on payments or not able to finish those products. So we're looking into trying to tap into those resources to see if they're willing to sell some of that paper as well. Or we can continue, those projects that are local to us in the area. So that's where we see the opportunity over the residential asset class, the second mortgage note asset class, and also the private lenders and hard money lenders who don't want to finish the renovation. Like you guys, if you lend money out is in your area, you'll finish the renovation, put it in the market. There's a lot of players in this space that's not willing to do that. Smaller private lenders and or bigger hard money lenders that put a lot of money on the street, so to speak. So those are the opportunities that we see in the different asset classes where we are.
Well, I can tell you that we don't want to finish up any projects.
We don't like it anymore.
So
We just soon move them.
so, that's what I mean. We'll definitely reach out to lenders such as yourself and see if you guys want to get rid of that paper for a nice discount and keep it moving.
Yeah, we've learned that return on effort the hard way. So
Return on time.
That's right.
That's for sure.